Yeah, I wanted to make a quick video about seven ETFs that I am buying in 2025. First one is the iShares MSCI USA Momentum Factor ETF. Now, this ETF targets the top companies that are having a good momentum. And by momentum, I mean that it's going up and it keeps going up. Actually, this is a good strategy to buy a stock when it keeps going up. You're probably better off buying a stock which is a positive momentum than a stock which is at a 52-week low. Even if intuitively could be like a good buy to buy low, in the reality, more than not, you're better off buying a stock that it has a positive momentum going up. Usually, when the price is going up, it's because there are more people buying, and the momentum is going. Of course, if there was something to happen to that stock, there are going to be a lot of people selling out of that stock, and they're going to sell by the bulk. Now, this ETF targets again the stocks that are going positive, they have a good momentum. Now, over the past year, this stock is up nearly 37%, and I'm pretty sure that it's more than the S&P 500 that has been going up over the past year. In fact, if you look at the S&P 500, for simplicity, I use the SPY, which is provided by State Street, and compare that to Momentum ETF. Of course, you see that the green line is always above the blue line, which is the S&P 500. Now, as far as the stocks that are held in this ETF, let's see on the holdings, we got about 27% technology, 22% financials, about 12% consumer defensive, and the top 10 stocks holdings are JP Morgan, Walmart, Nvidia, Costco, Oracle, AbbVie, Philip Morris, Intuitive Surgical, GE Vernova. Those are only the top 10 out of 128. When it comes to the fee involved with this, let me see. It's got a 0.15% expense ratio, which is quite cheap. Of course, it's not as cheap as just buying the S&P 500. S&P 500, whether you buy through Vanguard or through BlackRock or through State Street, they charge you 3 basis points. So it's about 5 times what it would charge you. But I mean, if it's worthwhile to you, I would definitely recommend this Momentum ETF over the S&P 500 for appreciation. Now, the other thing too is that the dividend is a bit low compared to the S&P 500. S&P 500 usually yields 1.5%, while this one yields 0.71%. When it comes to the rating, Seeing Alpha analyst says that this is a hold with a 1 to 5 rating of 3, and the quantum rating is actually a buy, and they rated at 4.35. Now, like I was saying, this stock has got a good momentum. Expenses are a little. Let's say it's not too bad. It gives like A minus. Dividends, like I was mentioning, a C minus. It's got a low risk and a good liquidity. Now, I'm a huge fan of this Momentum ETFs. The other thing is that you can buy the same thing through Vanguard or through Invesco. I believe that the Invesco is SPMO. This is the Invesco S&P 500 ETF. It's got a double buy rating here from the Seeking Alpha and the Quantum rating. The expense ratio is slightly lower, but the yield too is way lower. When it comes to holdings, this one, technology 24%, financial 23%, consumer cycles about 13%. There are some of those companies that are the same, some of them are not. Here you got Amazon, Nvidia, Broadcom, Meta, Berkshire, JP Morgan Chase, Eli Lilly, Costco, Walmart, GE Aerospace are the top 10. Let's see how this compares with those other two. SPMO, Momentum, SPMO. This is actually even better performing over the past years. Over the past 6 months, it's about even with the momentum provided by BlackRock. Over the past 3 months, it's still come up on top. Now, I think this is a good alternative. If you like Invesco better, you can go through Invesco. Now, in general, I like better BlackRock, and you can look up the financials of both BlackRock and Invesco. I think BlackRock, being the largest asset manager, gives me more security, more peace of mind. But Invesco too is a good company. They got the QQQ. And the same thing, you can look up the Vanguard Momentum ETF. Those are very good ETFs. If you are willing to beat the S&P 500, at least in the short term, I believe. My second recommendation is the XLK. Of course, the XLK provided by State Street is a very, very successful ETF that targets the tech companies. This has got a expense ratio of 9 basis points. The dividend, it's 0.65, which is lower than the S&P 500. But I like this one because basically 25%, if not more, of the S&P 500 is tech companies. So the tech sector is what drives the whole thing. Of course, the top 10 holdings here are pretty much similar to the top 10 holdings of the S&P 500. It doesn't have Google, I don't think. So usually when I buy this, I also buy Google separate. But the top 10, of course, by market cap are Apple with a 14%, Nvidia 13.5%, Microsoft about 13%, Broadcom about 6%, Salesforce, Oracle, Cisco System, Accenture, ServiceNow, and IBM. Those are the top 10 holdings, and this ETF contains 72 holdings in total. I buy this with consistency because, again, if there was to be the new Nvidia, the new Tesla, I believe that it's going to be a tech company. Okay, I don't see a bank or pharma being the next a trillion dollar company. So I stick with the XLK. Let's also see how that performs compared to those other ones. Let's keep the BlackRock for now. XLK over the past year is up about 30%, and it's better perform ETF than the S&P 500 over the past 2 years. Over the past 2 years, it's up a lot. It's up about 75%. while the S&P 500 it's about 50%, and over the past 3 years it's still up. So again, XLK is a very good choice. Let's say next, it's a semiconductor ETF. While I don't usually recommend the sector ETF, I mean, you're always better off buying a sector ETF than buying an individual stock. The semiconductor. Now, of course, this was quite hyped with the semiconductors. Now it's cooled down a little bit, but I believe that the semiconductors are always going to be leading the economy. There is always going to be a growing demand for semiconductors, and for that reason I believe it's a good investment to buy this one, the SOX, which is provided by BlackRock. Also there is the SMH. It's a little different. It's another semiconductor ETF. Now this one is more concentrated. It only holds 35 holdings. Nearly 11% is Broadcom, then over 7.5% Nvidia, AMD about 7%, Qualcomm about 6.5%, Texas Instruments about 6%, Marvel Technology about 5%, KLA 4%, and so on. Micron Technology, Lam Research, and Applied Material. Those 10 stocks make up about 59% of the total holdings. That are 35 again. Now this also you can buy the SMH. It's the VanEck semiconductor. Like you say here, Nvidia makes about 20%. Taiwan 13%. Then you got Broadcom, ASML, Applied Materials, AMD, Qualcomm, Texas Instruments, Micron, and Lam Research. About the same stock here, the same stocks here. You see Taiwan Semiconductor. Let's see how they both perform relative to the S&P 500. S&P 500. I think SOX performs better. At least the last I checked. SMH. No, SMH, it appears to outperform both, at least over the past year, over the past 2 years. Same thing. SMH provided by VanEck. I mean, you can buy a combination of both. I think it helps to spread your risk. But I feel comfortable with BlackRock rather than VanEck. The other one ETF I was gonna mention here is VT. VT is the Vanguard Total World Stock Index Fund ETF. This actually underperformed the S&P 500, but the majority of this is again the S&P 500. S&P 500 contains about 500 positions. Now this contains much more holdings, many more holdings. In fact, this contains nearly 10,000 holdings of the whole world. Like you see here, Taiwan Semiconductor, which is of course a Taiwanese company. Again, it's got about 18% of this, which is emerging markets, and it's got about 20%, if I am not wrong, of the European stocks. Let's see on the Vanguard website. This is VTI. VTI is good too. Of course, is the total US stock market, not only the top 500. VT. The VT. the VT ETF. Let's see if here it gives you what percentage is what. The price is 119. Okay, portfolio composition, about 10,000 stocks. The P ratio 21.4, price to book nearly 3. And here you can see how the majority of this ETF is North America. Then you got emerging markets about 10%, Europe about 13.5%, and the Pacific 9.10%. Now, for those of you guys that are interested in international stocks, I believe that this is your best bet, because again, automatically it rebalances it with the overall performance. Like 10% emerging markets, I'm pretty comfortable with that. 13.5% of the portfolio Europe, and 9.10 Pacific. I am very comfortable with this, how this is broken down, because see, you never know the next Nvidia, the next Tesla, whoever that's gonna be. It might not be an American company. Now, I don't really see that happen, but you never know. You can have a company from China or a company from Taiwan that is gonna grow a lot, and now if you buy VT, you're gonna own that company by default. Okay, now those are the top 10 holdings here. Like you see, they buy Taiwan Semiconductor directly from the Taiwan Stock Exchange. Let's see, those are good companies. Let's see here. Like I said, the majority are US companies, but it also contains some of the best companies from outside the US. Like in this case, ASML. This is a Dutch company, I believe. SAP. This is another company from outside the US. Novo Nordisk, same thing. Those are very good performance that are not included in the S&P 500, of course. So it's worthwhile to look into this. It's got Nestle, it's got Accenture, Toyota. Those are very, very good companies, and I like holding those companies in my portfolio. Like I say, they underperforms the S&P 500. Now, the other one that I am buying is SCIM. This one right here, it's had a great run, expense ratio of 0.15%. The dividend is a bit low with less than half a point, and it says here D minus the dividend. Of course, expenses, it's got a good momentum, good liquidity, low risk, and this also is rated a buy by the quantum rating. Let's see here, the quantum rating. Basically, the quantum rating is right more than not. Here where it was gonna say to hold it, then to buy again. That green is a strong buy and a strong buy again. So you see how the rating has changed over time. Very good stock, SCIM. Let's see. Technology about 32%, consumer cycle 13%, healthcare 13%. I think this is a good ETF to own for diversification too. It's got 64 holdings. Nvidia number 1, Apple, Meta, Alphabet, Arista Networks, Microsoft, Walmart, Axon, which is what provides all the cameras, the body cams for all the police. And so on. Now this ETF provided by SCI Investment, it's got about $500 million of asset under management, and let me plug that in. SCIM, in the green, and like you see, it outperforms the S&P 500 over the past 6 months. Too, the S&P 500 is up about 10%, and this is up about 20%. So definitely one of my top picks this year would be SCIM. To be honest, I don't know much about the company that provides it, but I like it. I'm gonna add it to my portfolio. The other one, it's similar, and that's the Fidelity Enhanced the Large Cap Growth ETF FELG. And again, those are all good company. I see MasterCard here. I'm a very big fan of MasterCard. I think that if I was to pick one individual stock, it would be MasterCard. Now, of course, right now the valuation of MasterCard is way too high for me to buy, so I'm holding it. Let's see the ratings. Basically, it's a buy on the quantum rating and a hold on the Seeking Alpha analyst. Pretty much similar to those other ones. The only C minus is on the dividend side. And I believe too that's how those companies make money, like Fidelity. I feel very comfortable with Fidelity. What I like of brokerages providing ETFs, BlackRock, State Street, Vanguard, Fidelity, and then all the others in this very order. Now I do like BlackRock because it's a public company and everyone can see their financials, but I also believe that it's good to be a private company, and that's why I'm a really big fan of Vanguard, which is a private company, and Fidelity, which is a private company. But of course, asset under management, BlackRock is the best. Now I do like State Street a lot, even if it's a public company, because once again you can see all the reports every quarter, and basically State Street is more conservative than BlackRock. You can see from how much debt they've got compared to how much debt BlackRock has. Looks like the BlackRock, the share price has been going up a lot, a bit driven by FOMO, by speculation, while State Street, it has been going up too, but I believe that they're more conservative on the money that they keep in the bank compared to the assets that they have under management. I feel very, very comfortable buying State Street ETFs. Let's see how this performs. It is FELG. FELG, and in the green line too, you see it's beaten the S&P 500. It's about 30% on the year, and the S&P 500 about 20% on the year. Over the past 2 years, actually over the past 2 years, the S&P 500 has underperformed. But this Fidelity ETF is quite new, so that's why I would give it some time. Actually, I believe it hasn't been traded long. FELG, it has only been traded possibly not even 5 years. Yeah, actually it's a new ETF. It was founded in 2024. Oh, actually November 2023. So I would give it time. Now, of course, those are my top picks for the large blend. Let's see, a diversified ETF, and I'm buying those basically on a daily basis. Now, those are ETFs that I buy for the long term. I have a trading system to where I make money daily or weekly whatever it makes sense to buy and sell, and then all the money that I make, I'll put them into the ETFs for a long-term hold. But I like a couple of sector ETF that you can get. The one that I'm a big fan is the Global X AI and Technology ETF. And again, it's provided by Global X. It's got 65% of technology. And this is how it breaks down: Tesla, Broadcom, ServiceNow, Netflix, Cisco System, Meta, Salesforce, IBM, Amazon, Oracle. Some of the same companies, but I like being diversified. Of course, those companies might change, and those percentages too might change on a daily basis, on a weekly basis, according to the company's performances. Let's see the rating on this one. It's got a double buy. I think this is a bit too expensive. Let's see on the expenses. It's about 0.68. That's quite a bit, but nonetheless, I think that's a good ETF to buy, including all the AI companies. I believe that the next big company is going to be in the tech environment, and it's going to be an AI company, of course. So I'm a big fan of AIQ. The other one, which is always the AI ETF, is ORTI. It's provided by BlackRock. Let's see this one. It's got over 82% technology. Expense ratio of 0.47%. It's not that cheap. It's got nearly $1 billion of assets under management. Holdings, of course, once again, some of the same companies. But again, they're the same companies now, but they might change according to what BlackRock is going to do versus Global X. Now here you got nearly 6% of Broadcom, nearly 5% of Arista Networks, Vertiv Holdings 4.7, Nvidia 4.4, AMD 4.16, Constellation Energy 3.7, Super Micro. This is a bit of a speculation here, but nonetheless, you're only talking about 3% of the fund. There was something to happen to the Super Micro stock price. They might just kick it off or kick it out of the holdings. The other one is Buy. It's a fairly new AI ETF provided by BlackRock as well. Let me look at the holdings here. Once again, this is fairly new. It doesn't even make sense to compare it to anything. It's got about 72% technology, 13 communication, 7.3 consumer cyclical, industrial, over 7% of industrial. Now this I bought a bit. I'm buying it in tranches. I bought a little bit of this. It's got Nvidia, Meta, Microsoft, Broadcom, Astera Labs, Amazon, Taiwan, Reddit. I like that there is Reddit here because Reddit uses AI. Of course, Reddit stock price now it's blowing out of proportion, but you never know in the long term what Reddit can do. Tesla is in Cadence. This is a good stock here. They design software for semiconductors. So I believe Nvidia, their customers, all of those companies, they're customers of Cadence. It's Cadence and Synopsys. They're two good stock. They compete. And I'm very comfortable holding both of them for the long haul. Well, I feel like those are my top 6-7 ETF I'm gonna buy. The market ETF, of course, index fund. I don't even talk about those SPI, VO, AVV, because everyone knows those ones tracking the S&P 500. Those ones of intelligence, or rather AI, I am a big fan, but be careful. Like you always better off buying a diversified ETF. Like you see here, like the momentum ETF. It contains, like this one from Invesco. It contains companies from basically any sector. It's got Amazon, e-commerce, Nvidia, semiconductor, social media. This is a financial company, Berkshire. Then you got bank here. You got a pharma. You got a retailer, another retailer, and GE Aerospace. So my suggestion to you guys: always buy a diversified ETF. The moment that you're gonna go in a sector ETF, you can, but you're taking a chance. Okay, maybe you can allocate some of your money to a sector ETF, but the bulk of your money should be in diversified, large cap, large growth, ETF, which includes companies from all over the sectors. There was a YouTube video that was talking about the momentum ETFs. I'm a very big fan of those, because basically at any given minute you're gonna have the best of the best. They do all the work for you. Like if you buy momentum from BlackRock, you can only buy once, or you can dollar cost average into it, and you always be sure that you have the best of the best. Now let's see what this guy says on the momentum ETF. I think this is a good video. I only watched a little bit.
And today's contest is a quadruple header between 4 momentum-focused ETFs. It's another audience-requested contest. This time it's iShares, JP Morgan, Spiders, and Vanguard facing off. Who wins the battle? Find out right after this. Welcome to ETF Battles. We're in Season 3, and if it's your first time here, be sure to hit the subscribe button, like our content if you've been enjoying our shows, and if you've got a specific ETF matchup that you'd like to see, post your ETF ticker symbols in the comment section below, and we will look at it. Now, today's ETF battle was sent to us by Thomas Beck, and it got a lot of likes, a lot of thumbs up, so that tells me that there's a lot of interest in momentum investing and ETFs linked to it. So congratulations, Thomas, you win a ETF Battles shirt because we chose your contest, your tickers. And so be sure to visit the comment section below and the instructions to claim your prize. Today's contest is going to be judged by Dave Natick with the ETF Trends and Todd Rosenbluth.
I don't know why the MMTM, it doesn't come up. At least on Seeking Alpha, which is the State Street. Yeah, it comes up. It comes up. Let's see, this one, it's the same philosophy. It's only that it's a $267 a share, and it's provided by State Street. It appears it's a bit more diversified. Yeah, it includes about 1,500 stocks. Okay, that's another alternative that you can get. Actually, I'm gonna add that to my watch list too. MMTM. I don't know why it doesn't come up on Market Watch. MMTM. Oh yeah, it does come up. Well, it overperformed the S&P 500 too. Not by a lot, but definitely, So that can be another alternative. If you are a fan of the State Street, you can buy MMTM.
Hey, research guys, welcome back. Great to see you.
Great to be here. Thanks for having us.
So we've got our 4 battle categories, and this, of course, is a quadruple header. There's so many M's in this particular battle. I may have to just eat some M&Ms while you guys are talking about your analysis. But we've got cost, exposure, strategy, performance, and then the mystery category. And for the mystery category, that's our Alfred Hitchcock favorite. It's the one category where our judges get to pick a single factor or maybe multiple factors to support their analysis. And mystery category is known only to the judges themselves. So let's begin with the first category to kick this battle off. And then, of course, I should mention at the end of the show, we'll declare an overall battle winner. Program may end in a split decision. We'll just have to see what our judges come up with. So let's start with cost. Todd, please get us started.
Well, this one is a tough one because all of these ETFs charge you between 12 basis points and 15 basis points from in terms of an expense ratio standpoint. So I'm actually going to choose the one that I believe is the most expensive, MTUM, because it's the largest, it's the most liquid, it trades the most. It is 3 basis points more than some of its peers, but that's okay because you're making that up if you're moving in and out of it at some point. So I'm going to go with MTUM as my winner, but all of these you'd be fine with from an expense ratio perspective, in my view.
Thank you very much, Todd. I got you down for MTUM. Dave, how do you see it in terms of cost?
I'll split the difference here. I'll give it to JMOM at 12 basis points. It's technically a little bit cheaper, but Todd's fundamentally right. There's 3 basis points splitting these 4 funds. The cost differential is not going to be the difference in your performance. These funds are going to perform wildly differently with way more than 3 basis points worth of variance on any time frame, even one day. So the difference in expense ratios here is largely irrelevant, but I'll give it to JMOM anyway.
Thank you very much, Dave. I got you down for JMOM. We next shift to exposure strategy. So, Dave, you're still up. How do you see it between these 4 ETFs?
Well, this is a bit of the big lift here. This is where these funds are actually pretty different. NTUM is a pretty dirt standard large mid fund using a pretty straightforward methodology looking backwards at price performance with an adjustment for volatility. So it's trying to get you that risk adjusted return that you want out of a momentum strategy. You can say that a little bit about everybody else here. MMTM for its part starts with a full 1,500 security universe and actually includes all of those securities. It just plays with the weighting to try to get you a little bit of a momentum tilt while still being effectively a total markets fund. JMOM uses a proprietary index that does sector matching, which is kind of interesting. And then last, VFMO is actually an all-cap active quant strategy. It's not even tracking a direct index. If I had to pick between one of these, as much as it pains me, I think I'd lean into the most boring of the 4, which would be MTUM. Largely because if you're going after a momentum fund, you want something that's going to show you momentum when the numbers come out. This is the most momentum-y of the portfolios here, and for that reason, I give the nod.
Thank you, Dave. I also like that word, momentum-y. Always inventing new words. That's great. You see, we expand our language on ETF battles, and that's fantastic. Great analysis.
It's all part of the service.
Very good, very good. Okay, so let's shift to Todd. Todd, how do you see it in terms of exposure strategy?
Yeah, so Dave got the facts right, but I just think his analysis of those facts are wrong. So I'm going to go with JMOM. I actually don't know why he's spelling out the ticker. JMOM. Who doesn't want to say mom as part of a video that we're doing here? The problem that I have with MTUM, as good as it is at providing exposure to it, is that it's semi-annually. So that's the big difference. With the Vanguard product, it's active in the manner that they can make changes whenever they want to. That perhaps might be too much. The Spider product, it actually slowly tilts a little bit and a little bit here and there, and it's pretty much giving you most of the exposure you get from the S&P 1500. I'm going with JMOM because it's 300 stocks, it rebounds quarterly, and it's got that sector neutrality. So it's finding the highest momentum stocks on a quarterly basis that's frequent enough, but not too frequent, and not taking on sector bets. So from a core part of the portfolio with a momentum angle to it, I'm going with JMOM. And I'm going to get Dave to say mom before this is over.
Oh, I will. Mom.
Very good. Thank you very much, Todd. We appreciate that. And hi to moms, right? Got to show love. Now Moms everywhere, exactly. Now we shift to performance, which is going to be interesting. So, Todd, you're still up. How do you see this quadruple header in terms of performance?
Yeah, well, J-Mom is the winner. It was the winner over 3 years. It by far was the stronger of it. If you look on a shorter time period from a 1 year basis, the Spider product, MMTM, not taking on that much momentum exposure, not shifting all that much, was better. And MTUM was by far the worst performer. It actually swung late into some of the sectors and then rotated again after the momentum had shifted quite a bit. So J-Mom is my winner here.
Let's shift to Dave. How do you see it, Dave, in terms of performance?
Well, I mean, I understand why Todd's holding out for J-Mom. I think we already know which way he's leaning on this whole thing. On a short-term basis, you can't argue with MMTM simply doing better and capturing this.
J-Mom, too, I bought it. It's a very good alternative.
Latest market. While I have other issues with it, I think I would give performance here to MMTM.
MMTM is your choice. I got you down. And in terms of performance, thank you, Dave. Now the mystery battle category, where our judges get to surprise us with their single factor or maybe multiple factors that they feel are meaningful to today's contest. So, Dave, what is your mystery battle category? What is it and who wins it?
Well, for me, it's factor exposure. If you're buying a single factor ETF, what you want is the maximum exposure to that factor. And how much you pay for it and what it performed in a given quarter or a given year should matter less than how purely you're getting that exposure, because very few people just own the momentum fund in a vacuum. They're owning it to either get some momentum exposure on top of a portfolio or to balance off. Maybe they've got a momentum value switching strategy they're using or something, right? So they get used as these tactical tools. For that reason, factor exposure is the mystery category for me, and I've got to give this to MTUM. As boring as this fund is, and it's as boring as you can make a fund like this, it is the most momentum-forward one of these products. Depending on how you measure momentum, I like the MSCI methodology for measuring momentum, and by their metric, this is by far the most momentum-y of these products, so it's going to give you that direct factor.
Now, just so you guys know, this video is from 2 years ago. Very good video.
Exposure. If I was going to split decision at all, it would definitely be down to J-Mom. I like sector balancing. I think that's a great idea. So if you're looking for a portfolio, J-Mom. If you're looking for a tool, MTUM.
So I hear a split decision there between those two. Okay, got you down for a split decision on your mystery. We shift next to Todd. What is your mystery battle category and who wins it?
So we at CFRA have a star rating methodology combining cost as well as risk and reward attributes. We have a 5-star rating on J-Mom, on MTUM, and on MMTM. So we have a 4-star on the Vanguard product. So we tend to like momentum strategies in this environment. We think they're likely to perform well over the next 9 months. So that makes it a little bit hard when I've got 3 5-stars and I'm supposed to like all of my children equally. I'm going to go with J-Mom because of the combination of risk and reward. It actually scores the highest on those 2 factors overall, and the ticker.
You just like saying it out loud.
I do. I actually don't know why this is not a more...
I like J-Mom by JP Morgan. It's the... For me, personally, I feel more comfortable with BlackRock or State Street. Those are the largest organizations when it comes to ETF. But there is nothing wrong with JP Morgan. It's up to you guys, really. Whatever you feel more comfortable with.
More popular product. It's actually quite...
I would buy all 4 of them. DCA into all 4 of them. They're all good. I buy those before I buy the S&P 500.
Small. I would think the ticker alone should be able to. It tells you what it is. It's pretty simple. It's way too small. So I'm going to go with a split decision, I guess, because the 3 5-stars equally. But my overall winner, I think we're leaning towards pretty obvious.
Wow, you're splitting down to thirds. That's a new one.
Well, if you guys want to, you can finish this video from ETF guide. I feel like wrapping up here, and I hope that this was helpful to you. I believe that those ETFs, it's really all that you need to succeed and make good money passively. Dude, you're not stock picker. You're not Warren Buffett. I know there is some magic about what he does and stock pickers, but possibly only two of you guys are gonna be the S&P 500. 90% of the actually managed funds don't beat the S&P 500. The best thing to do is buying a total world ETF and the momentum ETF, and then whatever sector you feel more comfortable. Like I explained, I feel comfortable with the semiconductors and the techs, but depending what your industry is, what your sector is, you might be comfortable with a different sector ETF. My advice to you guys and to all is to buy a diversified large cap, large blend ETF. And also Warren Buffett said that the best thing that you can do is buy a low fee S&P 500 tracker.